Tuesday morning, and it's a full house of green. The breadth, I think, is absolutely impeccable. I think impeccable is the word. 1:14 advanced decline ratio. You see that in a very rara kind of a bull market. The bank Nifty, will it make a comeback, or will it be back to again, a good start and then a slow stop? Some of the heavyweights, Infosys, Wipro, TCS, they are off to a good start. Dollar index is weak. Is that strength in commodity? So I will not be surprised if ferrous, and especially the global ferrous companies like Tata Steel, JSW Steel, they could be in for a good comeback. JSPL also could be a decent one to watch out for because they've reduced their debt. Now let's look at the real patronized trader stocks. Suzlon, JP, Vodafone. What's the pattern there? Suzlon, JP, Vodafone. Suzlon 41.5. Can come down to sub 10 rupees. JP Associates 19 rupees. And then Idea Vodafone hit a fresh 52-week high, I think earlier this week or last week. Now it is at 14. So it's just been a full all-round performance, at least for the market in terms of the opening first rates. A lot of green on the screen, I think, is visible.
Yeah, a lot of green, and that is visible in the advanced decline ratio. But leading from the front is the real estate pack, not just Suntech Realty, which was actually in initiation. Look at a Mahindra Lifespace. That stock is higher by 5%. Oberoi, which is making its foray into Gurugram, as well as announced one new project, a luxury project in Thane, is also seeing a positive reaction. As we talked about the dollar sitting at 2-month low, there is a positive momentum in metals. So whether it's a Hindalco, a Hindustan Copper, a SAIL, all of these stocks are doing well. And in fact, metal is one of your top gainers in terms of the sectors as well. IT, PSU banks, energy, these are some of the sectors which are leading from the front. In stock-specific action, you have Latent View, which is up around 3.5%, KEC on account of that order win, and ditto can be said for other companies as well, which have backed some orders. Electra Green Tech is higher by 3%. JBM Auto, another EV, commercial vehicle plays higher by 3%. So a couple of these names deserve mention. And then Tata Invest, that continues to run quite a bit. It's 3% higher, and we were highlighting how this entire holding companies are coming back in focus, and seems like there is no discount as far as this holding company is concerned as well. On the losing side, Coal India, ONGC, a couple of these PSU energy plays. KPIT Tech is also softening a bit, so we are seeing a bit of a negative reaction. And Nykaa, Kalyan Jewelers, Max Health, these are some of your other losers, but it's more green than red, Awad.
It is. The breadth is skewed in favor of the gaining side, as you can see, quite firmly. And while those movers that you mentioned on the downside, that is made up by the likes of a Mishra Dhatu or a Welspun Corp, a Solar Industries, or even a KEC International for that matter. Time to find out what our chartists are looking at when it comes to the screen. And 19,750 being conquered. Kunal, what do you make of the initial ticks, and what would be your first trade?
I think it's a good start. We've managed to surpass the last, 1 day of swing high, at least on the Nifty. So we'll wait out for more follow through on the upside. IndusInd Bank is something which I'd be bullish on. I think yesterday the stock closed at 1500 odd levels, which is also closer to the previous swing highs, as well as completing a bullish pattern on the daily charts.
All right, there you have it. And Naresh, let's get in your first trade.
So that would be a buy on Bharti Airtel, a new all-time high here. Looks momentum is set towards the 1,020 mark.
All right, now let's talk markets, valuations, momentum, and the risk-reward ratio. Venugopal Gare, Managing Director with Bernstein, joins us. Venu, good morning. Thank you for joining us. There are enough and more reasons why one should buy into large-cap stocks and one should avoid mid and small-cap stocks. But markets are just not obliging. Large-cap stocks, especially banks, they continue to languish. Small-cap stocks and mid-cap stocks, they continue to flourish. Do you think we are reaching a point where risk-reward ratio is not favorable now for the broader market per se?
Yeah, I mean, this has been one of the questions which has broadly, or a thought which has been going the rounds for quite a bit of time now, as to when to get out of SMIDs and potentially invest in large caps. I would just highlight what I've been thinking about it, at least until now. For me, the broader thinking was that since my top-down Nifty target itself was closer to 19,000, and remember that I'm actually still positive on the market on a 3-year view, with a broader view that one should be buying corrections in the market, at least at an index level. But I had been holding a very positive view on SMIDs until now. And my thinking was that if I look at mid caps at 25x PE on a 1 year forward basis. They're still offering you on an average 30% growth, at least the index, growth that is there. Well, Nifty is something like 12.5 or 12% odd EPS growth on a 12-month view at around 19x or 18x PE. So if you were to just look at broadly from an index standpoint, you may not necessarily essentially see too much of an arbitrage, especially from a fair value perspective. But yes, and the argument could be that, the ratio of SMID's, multiples to Nifty multiples have expanded, especially over the last 3 to 6 months. And the second challenge that you would potentially find is that it is becoming more and more difficult to get sort of obvious ideas in terms of what to purchase. So you're running out of bottom-up ideas as well, because whatever you see would have gone up 50%, 70% growth rate. So that's like a usual challenge that you usually encounter. Now, my thinking is this, that, broadly this call of rotation kind of a thing is also an element of flows, which essentially which deliver that. Yeah, you could probably look at a situation over a 12-month view. There could be a potentially higher return for, let's say, some of the Nifty stocks compared to SMID. But I think I would still be of the view that some of these SMID stocks, which are linked to very high growth end markets, it's going to be tough to bring them down very quickly unless the growth sort of disappoints. So we should focus more on growth disappointment, because if you were to clearly see one more last thing out in SMIDs, wherever there is not much growth, those sectors have not done well in terms of stock prices. So look at QSRs, for example, or chemicals, for example. So it's not like every sector in SMID has essentially generated a lot of returns this year. So my summary view would be that I guess we still have to look at a situation where one has to take an approach more from a point of view of bottom up. I don't think a large cap, small cap thing potentially works too much. Look for wherever there is growth at this juncture, but overall return expectations still have to be slightly low heading into the next 3 to 6 months, in my view.
What is your understanding about the flows into India? I mean, on paper, there is no argument that India is the best place where you want to incrementally increase your exposure. But if I look at the flows, it's just been on the other side. FIs, they continue to sell, and even though large cap stocks are looking attractive, they continue to sell more. Do you think this trend will only change and reverse post-elections?
Yeah, see, the flows aspect is interesting. Over a 2-year period, we've actually seen negative or outflows from FIIs, if you take a 2-year period, and especially the fact that whatever we saw as inflows in the initial part of the year, we started to see outflows now, right? So to that extent, overall, we've seen an outflow. And I guess a part of that has to also do with, global thought process on fund flows within a lot of global emerging market funds or global funds. And the potential challenge they find is that they're still very heavy with respect to their broader allocations to larger countries like China in terms of allocations. Now, if China is not doing well for them, the challenge that you typically tend to find is a situation where it becomes difficult for them to raise more money. And the number 2 situation which is happening is those funds are also shrinking, because you're actually seen outflows from China, which are not necessarily essentially coming back into the markets or getting reallocated to India. So I would argue simply that it is not just an India thing which primarily leads to these flows, because you can't really raise money just for India that quickly. So it's a very, very tough affair raising global money just for India. So one has to take that into also, a broader context. So I would say that a generally okay China is good for us, especially for emerging markets and for India as well. And number 2 is, yes, there is a broader worry or doubt or suspicion about what might happen to the next 5 years if elections don't really go in favor of what the market expects it at this juncture. So I think probably there'll be more proactive, allocations or reallocations which haven't happened until now into India as compared to passive allocations which have happened. Passive is, something is not doing well for you and you've not really sold India or as much, so you tend to see an weight increase. But that's going to change probably in 6 months from now post-elections. But I don't disagree with you on that.
Vinu, hi, this is Anisha joining in the conversation as well. And correct me if I'm wrong, but I see that your Nifty target is just around 19,000. So you're actually expecting a decline in the Nifty from the current levels. And despite that, your weight on mid caps is just 20%, while bulk of it is made by the large caps. Explain the dichotomy to me here.
Yeah, so just to highlight, I haven't really moved forward in terms of 1 year forward. So this 19,000 is something which was established in April when I upgraded India when the index was closer to 16,800, which is the broader buy call that I had for the year. Now, the more important thing is that this portfolio that we're running is primarily a large cap portfolio, given the nature of coverage that we have within the team, which is more large cap focused. So what we did is for the first time ever running this portfolio, or the paper portfolio as we call it, for the last 3.5, 4 years, we decided to do a special allocation to SMID, which is about 20%. And on top of that, we have 1 or 2 SMID cap stocks as well out there, which have 5 to 6% allocation. So this 30% odd allocation, if I were to add that as well, is actually quite large in the scheme of things, that it is a large cap focused portfolio, right? So this itself gives you the message. Number two is, look, I would probably say that this entire thinking about 19,000 or 20,000, it's also a broader construct of, when I sort of move forward, it will be more closer to 20,000, but that is broadly the range. So I'm not really looking at this juncture, the market to go up above that range. And my thinking is all these big, not really big, small corrections that you would see is the one which you need to keep buying with a 3-year view in mind. That's the way I'm looking at basically, or arguing a positive view on India.
So you're expecting the index to stay between that 19 to 20,000 range, but just specifically talking about some of your long ideas, I see Zomato in that list, I see Paytm and delivery in that list as well. What's the view on these after the run-up as well? Would you continue to maintain those long ideas? And why doesn't NICAD sector feature in this list?
Yeah, so our broader thinking primarily was more centered around business models where we potentially felt that the competitive risks are relatively lower. So that was one broad thinking. So if I look at all the 3 consumer tech companies that we have, they are primarily dominant players in their respective end markets. And I don't really see them being in a situation where competitive risks are going to be intense. So that's the way the selection was essentially done. So 2 of them, which basically one of this e-commerce logistics company and the other is a food delivery company, of course, were introduced much earlier. Paytm was more a recent introduction because the coverage came in more recently, but it's the same situation there. But broadly, overall, consumer tech as a space, we went overweight in January of this year, which was our way to play IT overweight. Right? So that's the way we had sort of squeezed out of their IT services, positions. But that's something we are going to actively be relooking at as to whether to tilt that position a bit more favored towards IT services, for next year.
Wanted to also understand your outlook then when it comes to IT and financials, because it's a moderate overweight on overall IT while you seem to be overweight financials. Don't you believe that perhaps now the worst in terms of concerns for IT is now behind us, and that maybe it will be the banks that will take a backseat?
Actually, banks haven't done really well, if you were to look at year to date. Quite a few of these private sector banks, especially the larger banks, including private sector banks, have either flat or down YTD. So, and especially at a time when, things are looking fairly good from a cycle perspective. I would probably say that when it comes to next year or the year after, it's very less likely that the financial sector doesn't sort of get back its leadership. So I think it pays to be overweight on laggards like financial sector at this juncture. IT is not an easy debate because at least in financial sector, you have a cycle at work where you can actually visibly see things sort of improving over time. And as I say, broad basing of the overall credit portfolio from just consumer oriented portfolio to more an industrial portfolio as things pan out well on the broader economy over a 3-year view. That sort of brings in, some stability of a semblance of, risk level worries coming down, which is what typically, investors worry about at this juncture, that that's still a narrow focused portfolio. So, but in the case of IT, I think it's a much broader call one has to take. I think at this juncture, one can take a valuation call, the fact that the sector has derated and come closer to an earnings growth where perhaps further downward revisions are perhaps less likely. So the nature of the call is very different, I'll probably argue. So we are actively looking at thinking about at some stage, maybe next year, whether we should have a much larger overweight for IT in general. Remember that IT mild overweight that we have at this juncture is funded entirely through consumer tech because it's not IT services, it's actually tech as we call it as.
There is really something special happening in the US tech space. Looking at the valuations of Nvidia or Microsoft, or for that matter, even Apple now, market caps of trillions of dollars are getting created. If one has to look at that as the mega trend where IT is where all the action and excitement is, what is the best way to participate in India? And Indian IT companies, the large ones, perhaps don't offer this play. But when such exciting things are happening in the tech world, how can Indian investors participate in that?
I would say this is a very important question, but very tough to answer because of the nature of opportunities you get in India. I mean, if you can actually still invest in those global tech companies as Indians, perhaps you should. That's the way I would probably argue as the simplest way to do it. And these are business models which are very futuristic, which are offering you growth, which are offering you global exposure, right? Because they're not like local companies just exposed to the US market, right? So that's like the opportunity spectrum those companies get. But if I were to look at India, see, IT services is a real bread and butter business, which means it cuts across industries. So it's something which is more like akin to a utilities in some way, right? It's a very critical function, but then it's nothing related to pure high tech. It's spread across every industry. So they tend to be more generic in terms of growth rates or more slower in terms of growth rates. So perhaps that's not the right way to play even something like an AI, for example, because that's like an incremental driver, if at all, in terms of opportunities that these companies will get. The other way to look at that perhaps is something like manufacturing. Maybe that's not like a bad approach to look at. If some of these supply chains for tech products start to come out here, which could be, some opportunities with respect to, assembly of anything, be it, a PCB assembly or a assembly of a product, maybe that's not a bad way to look at scale up. All of those are 50 to 60 XP companies, but maybe that's the other approach because you don't really have true high tech per se in India at this juncture. And I don't really see that actually changing as well, at least in the medium term to long term.
Okay. Now, specifically on IT, because this is like the biggest debate. The purists would say that IT sector has seen the adjustment of Y2K, it has seen the adjustment of SMAC, it has seen the adjustment of enterprise, and yet IT companies have emerged better. The same purists are saying that what is looking like a challenge right now, AI is something which will help Indian IT companies. The naysayers are saying that this time it is different and AI means this is end of the so-called body shop model for Indian IT sector. So it's a hot debate right now. Which part of the debate are you on?
I'm actually in the positive debate. My thinking is very simple that, see, India over the last 30 years has created only one big moat, which is basically IT services. There's a huge talent pool which is available within India. And more importantly, every transition that has happened globally in terms of tech transitions, these IT services companies essentially have molded them to cater to those transitions. And so is going to be the case with AI. AI is actually two things in my view. One is it actually increases efficiency for a lot of these IT services companies. And at the same time, it offers new opportunities within the spectrum of digitization. And I think this entire journey of cloud digitization and throw in AI opportunities, which is, more to equip a lot of these companies to be able to be future ready, IT services pretty much is going to be on the forefront. That's a reality of how things are going to shape up. So I'm actually on the positive side of the debate. The unfortunate reality is that, this sector tends to being given this sort of a treatment of, trading at 19 times or 20 times P, where you have sectors like FMCG with similar or lower growth rates at times trading at 50 times P. So, that's an unfortunate reality of how these things shape up. But, I think one should be positive on IT over a 3-year view.
Interesting, really looking at leveraging that overall AI and new age tech opportunity within the entire space. And I'm curious as well to get in your take then, Venu, on crypto and Ethereum, because that's about 2% of the portfolio.
Yeah, so unfortunately, we had the flexibility of, looking at assets outside of equities as well. I do play sometimes into fixed income, wherever I can. Last year, for example, I had exposure to fixed deposits as well. We had 7% interest rate. That did really well for me till March. And thereafter, I removed that. My thinking this year was primarily that the world is not falling apart. Global, there could be recession, but not like a deep downturn. So what it meant to me that the semblance of broader global stability and US being okay in terms of overall environment primarily meant that there should be some degree of a risk on. That was my thinking, which is the reason why I was short gold and long Ethereum. So, and thankfully Ethereum has been working for us this quarter. But that's a broader reality as to why this positioning was sort of created.
Before we let you go, I have to discuss financials, right? You still continue to be bullish around that, given the fact that it's underperformed, you said. But what within financials? Because that too has become a very, very diverse theme. There's insurance, there's, stock market related ancillaries, there's obviously NBFCs, private banks, PSU banks. Within this entire spectrum, what would be your pecking order?
Yeah, so, I normally played around the broader spectrum of our coverage, and our coverage is more centered around banks, not around insurance and asset management at this juncture. But my thinking is that purely from a growth perspective and where they are on valuations, both price to book relative to history and more importantly relative to other sectors on earnings growth as well, we are, and I would perhaps say that the top private banks would be the priority at this juncture, because I don't really have too much regulatory risks to also contend with, for that particular pack. So that will be still at the top of the pack, which is what we are essentially playing at this juncture. I haven't been too confident around NBFC models in general, especially the larger ones as well. So I have, in general kept away from that. So some of the SMIDs have really done well, but the way to play that for me was through my SPID allocation. So that's the way I am approaching financial sector, especially over the next 12 months.
Always nice to have you. India ka plan kab hai bhai? Let's meet for a coffee when you're here.
Yeah, sure. Very much. Next year.
Chalo, look forward to
Early
that.
next year.
Look forward to that.
Yeah.
What do we have on the market? We've got Axis Bank, which is steadily climbing. We've got Nifty, which is steady. We've got the breadth, which is looking incredible. And Nifty futures, by the way, are trading at a 50-point premium, which is not very large. The reason why I say it's not very large is because normally premiums, when you are on the cusp of a breakout, normally they swell up to 100 points, 120 points. But 50-point premium, 80% FI short, the market, guys, is still bearish. I mean, we may talk about, Nifty nearing 3% away from an all-time high, but the underlying fabric of the market is that everybody is either hedging and nobody is buying. But mid and small cap is where the excitement is, and EMS is where everyone is excited. For a company which went public less than about a year ago at sub 1,000 rupees, now reports are coming, and now the Morgan Stanley report, which talks about Keynes technology in terms of the new initiative, I think is something which we need to really focus on. So let me now bring on board Jairam Sampath, whole-time director, and CFO Ramesh Kannan, managing director and promoter. Gentlemen, good morning. Thank you for joining us. Whom should I address the first question to?
You choose. It is your choice.
Are you happy? Are you surprised at what's happening to your stock? You went public less than a year ago, and now it's 2,500. When it went public, it was an issue which everybody talked about. But 6 months after listing, I mean, the stock has just hit a home run.
Yeah, so the character of the company has not changed prior to listing to today. It is just that this company has taken a bit of time to, let's say, come to the forefront, aided majorly by the market tailwinds. We were preparing. It was like we did a lot of heavy lifting in the beginning. So it is not really surprising that what is happening now. Of course, the pace is a little bit scorching. So you want to add something?
Yeah, I'm happy that the stocks have done well. Investors are happy. I have been always telling my team to perform better so that whoever has had trust on us will continue to have trust.
Reaching that mark where now you are expanding much more than what you initially thought, let's say 3 years ago, because look at your fundraising plan, 1,400 crore. I understand that the landscape has changed, you are doing new tie-ups, the fabrication business is growing, but you're expanding at a pace like never before, and that also comes with the risk.
Yeah, so essentially the climate for investment is best because there are very favorable tailwinds, not in the marketplace alone, but in the government policies too. And we probably will never had it so good where all the three forces triangulated. One was the market condition, second is the government policy, and the third, of course, is the investor confidence. in our sector, which is kind of a newly minted sector, if you will. So the risk is essentially right now much lower, and the risk of not, I would rather say, risk of not doing it is much higher, because this is a futuristic thing. Individually, all the two businesses, which is semiconductor assembly and PCB fabrication, are by themselves good businesses. And when we add this to our existing EDMS business, or electronic design and manufacturing services business, this triple play is going to help the company in the future. And we are taking this time, next 5 to 10 years, to kind of prepare ourselves, so that we can then, when we do reach the global scale, we will not be found wanting in terms of competencies in these kind of critical areas. Because this is, we are working in an area which is highly, let's say, techie area. Every day there are newer things that are happening and so on, and we have to also grow. So all these put together, I think the risk is more if we didn't do it. So that's why we said we will do it, and it's quite affordable because of almost huge amount of subsidies that are available right now for the early players.
What happens
Added
now?
to what Jaram Sampath has been telling, as a company, we have mitigated all these risks internally by putting in strong systems in place. And I'm very sure and certain for this growth, we have put our system full in action.
Ramesh, PLI schemes are structured is that you have a deadline to meet. You achieve this milestone, you will get advantage of PLI schemes. How far are you away from that, that milestone which you need to achieve so that you would be benefiting from PLI 1?
Yeah, so this has got two components. You rightly pointed out there is a PLI component which we are still awaiting approval, and the primary component is as part of the India Semiconductor Mission's subsidies for initial capex itself. And that is a significant amount of subsidy. As per the government policy, it says up to 50% of subsidies available from central government, and state governments vary between 20 to 25%. The first phase, or whatever we call the Telangana phase, we have already got the state government's approval. We have also been allotted land, and we have, of course, applied to the Indian Semiconductor Mission, and anytime that should come through. And of course, PLI is an added benefit to this. So there are multiple, let's say, schemes working. One at the central level, there are a dual prong. One is PLI, the other is capex subsidy. And at state level, there is a capex subsidy. Plus, they also subsidize land, and they give you a lot of encouragement in terms of giving you very good positioning for the land, etc., which is near ports and all that. So it's almost as if the entire environment is egging us on and saying that please go and do this now, and otherwise later on don't crib that you don't have a conducive environment.
Mr. Ramesh, if I can get also you in the conversation, this entire semiconductor backward integration that you're doing, what exactly can it mean in terms of numbers? If you can lay out a few more details for us in terms of what's the capex investment, what kind of revenue contribution are you expecting, what could be the product mix going forward, given, of course, this foray into multiple segments?
Sure. So, as we had earlier announced briefly in an MOU with the earlier governments, etc., the total outlay, 2 phases included, is about 3,750 crores. At this point in time, we have sought a board approval and obtained it. And of course, we are at appropriate time, we will go to the shareholders also and get that approved. So we will initially raise about 1,400 crores, which will be sufficient to fulfill all the investment requirements from our side. And of course, the remaining comes in the form of subsidies from the state government and central government. So, this, let's say, broad timelines, let's say starting is this quarter, that is Q3, and by the Q2 of next year, let's say end of September of next year, we probably would have been completed the pilot lots and so on, and the next 1 year thereafter will be used for increasing the capacities and all that. So roughly 2 years of gestation will be there. In terms of numbers, etc., these are all categories which are asset intensive. So you can expect anywhere between 1 to 1.5 times the asset turnover. But that job is made much easier because we get almost close to 70 to 75% of subsidy on the capex from the governments. So that's why effectively it is not very different from our existing business, wherein we do about 6 to 7 turns on the assets. The added advantage here is that once we get through the initial starting points, post that we can access advanced packaging and some of those high density interconnection PCBs, etc., which are obviously much more value accruing, and they really place us at the top league table worldwide. There aren't many companies who have done this, and like I said earlier, the risk is in not doing it. Currently, all the conditions are favorable. So we said that, it takes a little bit of stress for Rameshji here. He has to do a lot of work, and of course, I support him. So other than that, I think it's good to attempt this now.
And Jairam, request you to stay with us. We want to talk a lot more about your fundraise plans, your product mix, your margin outlook, etc. Quick break. We'll be right back in 10 seconds. Welcome back. We're in conversation with Jairam Sampath as well as Ramesh Kannan of Kaynes Technologies. So, Mr. Kannan, I wanted to talk to you about the fundraise. The board had approved a 1,400 crore rupee fundraise plan. What is the timeline for this? And can you tell us the route and what the utilization will be?
Our board has approved our fundraise plan of 1,400 crores. We are planning to take it on
as appropriately based on our approval from the shareholders.
Approval from the shareholders, because our EGM is yet to happen. But we are in the market now looking for a QIP, and that is how we are planning to raise. This money we will be deploying in the next 8 to 12 months.
Okay.
And this will be purely focused on our semicon assembly project, as well as that is called OSAT project, as well as the bare PCB project. Finally, obviously, we are a few days away from completing our 1 year, and post that board has authorized us to ask for a EGM, and in that we will consider all the options, and we'll certainly come back to you. So obviously, it is 1 or 2 months away from today in terms of final fundraise.
Sure, point taken. But in terms of this 1,400 crores, which will happen over the next 2 to 3 months, are you getting a lot of interest from investors? And that's why perhaps you'll look at preferential issue, or you'll go towards rights issue and give the participation opportunity to the rest of your investors as well?
We have not yet taken a decision how
no
to
worries.
do it, but we are on a roadshow with our investors, and we will take a call at appropriate time.
Yeah. See, fundamentally, we need to do it ASAP. Every month you lose on this puts us back a tad as far as the development of technology and all that is concerned. So we will do the shortest possible way to get this money into the company, and then of course implement into the projects.
Sure. And just before I let you,
are open to us.
No, I take your point. Just before I let you go, quickly wanted to come back to the point in terms of how the margin performance will scale up, because as you said, your product mix is changing. What would it do to your margins going forward? What kind of upside should we envisage?
Okay. Firstly, this is a value accretive business. That means you will not have a downside to the margin. How much upside depends on how fast we get on to the higher end products, advanced packaging, as well as higher end PCBs. They are called HDI PCBs. So maybe for 1 or 2 years when we are developing, of course, the balance sheet will look at that heavy on investments. But post third year onwards, you will probably have whatever numbers that we are talking about. We are currently the EMS business, the EDMS business is doing about 15% kind of EBITDA and 10% kind of 9 to 10% kind of PAT. So this would be probably better than that. How much better? Time will tell.
I appreciate your time, gentlemen.
We need a gestation period of around 2 years for getting these 2 projects on streamline.
Thank you for taking time out, gentlemen. Appreciate your time, and thanks for all the clarity on how business is shaping up, as well as what the long-term growth plan is for Kaynes Technology. That's the stock price at 24.50. Quick break. Come right back. Welcome back. Still tuned into First Trades. What's going on with the markets? Well, we're holding out at 19,775. You've got the Sensex as well, which is up about 258 points. Strong momentum within the broader markets, a healthy breadth. Reliance Industries, metal stocks, HDFC Bank, Bajaj Auto, all leading from the front. But clearly, luxury is back in vogue and the premiumization trend seems to be on the rise. That's as per the latest report then from Macquarie. So let's talk a little bit more about the steady growth across the board within sectors with Avi Mehta, who's Senior Research Analyst at Macquarie Capital. Thank you so much for taking time out and joining in. I just want to understand a little bit more about this premiumization trend. Is it that we're now seeing the emergence of it as compared to what we've witnessed over the past many years? And what really is driving this appetite or this demand for premium goods across the board?
No, thanks for having me. So we were just following up on our earlier work where we had shared our views on how over the next decade, rising per capita income is changing consumer behavior towards discretionary spending. Now, this piece essentially highlights that this movement towards discretionary spending is a lot more towards luxury. And we have a series of charts where we are seeing this across spirits, across wine, across footwear, even in autos and electricals. And we think that this is a trend that is going to continue as the consumer remains aspiring and looks for a more luxurious experience.
I think this trend will continue because some would argue and say that we are talking about, let's say, 2-3% of the population, which is already affluent, which already has bought their Mercedes and their Louis Vuitton bags. So the replacement demand may not be that high. The Louis Vuitton bag gets a smile on your face. I can see that that's coming from a conversation you had with your wife.
Oh, thankfully not that is not the case. But the point that I'm trying to make, see, what I would argue is, increasingly, as we see across geographies, and this is not just India, we kind of look across countries in the world, what we've seen is as per capita incomes rise, we see a movement towards people wanting to, flaunt it, it's having that, a statement that they can make for luxury. And that is why we've seen that kind of pan out across spaces. And this in India, in our view, is something that has been happening and is going to continue kind of sustaining, simply because in India, we have that benefit of people being aware of brands a lot more, people having aspirations a lot more and know what they want. They are value conscious, but they're also, and that value also has some sort of bragging rights involved in that, which is what kind of drives our belief. And in our view, some names that we believe can kind of drive that benefit would be, say, Titan, where, clearly there is a movement towards people wanting that experience, people moving more and more towards studded. We like even companies in the auto space. So that's the thought that we are trying to kind of highlight in this.
What has been the historical trend when you look at these consumption patterns at a global level? Because what we are witnessing in India, perhaps it's the first time that the binge luxury spending has started. What has been the historical patterns when you see and when you examine, let's say, the European consumer or the American consumer, or for that matter, the Chinese also?
Actually, the easiest or the cleanest example, which is much more recent, would be the Chinese consumer, if I would put it. And in our earlier report, what we've highlighted, if you were to just track the per capita incomes for India with China and the rest of other geographies, we would say we are probably about 14, 15 years or so behind where China, and such while China was 14, 15 years back is where we are at. And if you look at the Chinese consumer right now, there is a lot of movement towards asking for a lot of luxury kind of goods. And India has taken that up a little faster is what we're trying to highlight. So, and that is the ethos of this report that we were trying to break out.
Okay. Which categories are you confident that the luxury spend could be not a multi-year phenomenon, but it could be a multi-decade phenomenon?
So we're classifying this movement towards three aspects, if I may put it. One aspect is this movement from unorganized towards organized. That is kind of getting played out across multiple segments. The second is the movement towards mix improvement. So, as an example, a simple example, you might start with having an aloo tikki burger and you might move to having a Maharaja Mac burger. So there is that movement also that is panning out. And the third movement is clearly towards asking for a more luxury positioning. So having something which makes you stand apart. So you, instead of having a local jeweler, trying to have something which is more design oriented, which is a lot more studded, which you earlier would not have thought about. And those are the three aspects through which we are kind of trying to develop some sort of index for ourselves, which is what we've used to reach the picks that we highlight. Your specific question about which sectors or which categories are we seeing this pan out a lot more? Clearly, the more high ticket it is, the more it is at play. And here luxury is obviously a lot more playing out in jewelry that you can kind of clearly imagine.
There is also a very interesting aspect to the Indian consumer, which is that the small town aspirational consumer who is now feeling rich and wants to feel richer by spending into luxury trend. What is your understanding of what will happen to the so-called luxury demand coming from small towns? Up until now we've always seen and thought that the large Indian towns will account for bulk of the luxury spend. But if I look at what companies are telling us, it's quite a stunning data which is coming from small towns.
No, you're right. I completely agree with you. I mean, that's the point. It's not the top 1% of the population we are talking about. It's actually a lot more ingrained as we speak. And which is why we are seeing this delve from, say, the top 20 cities, 30 cities, or 50 cities to more than 100 cities. And that's the opportunity that we are talking about. That earlier we thought that if you want to play luxury, you have to be in maybe Bombay, Delhi, and that's it. But now it is a Lucknow. It is more than the metros, but also the T1, T2 towns that you are essentially exploring. And that we are seeing it pan out. And this, in our view, is not something that will be, say, the next year or so. This is a multi-year phenomena, and that is what we want to make investors aware of.
Sure. Avi, where do you think we are in this cycle? Would you say we are just at the starting of that, at least, or we're at least midway through the kind of conversions that we have seen?
So, in this, typically the oft abused word, or whatever you want to call it, is the S curve that we say, and we are clearly at the start of it. So we had written a report last year in which we had contrasted this with, say, a Japan or a China, which probably are towards the fag end of that S curve. China may be towards the mid end, but so India is much more towards the start. And that's what makes it a lot more interesting, a lot more, interesting for people to look for.
Could be the risk to this? I mean, ultimately, it's the wealth effect which forces you to spend. The wealth effect in India has been a function of what's happening to the real estate prices on capital markets. Do you think if something changes on the real estate front, on the capital market front, this entire thesis could get challenged?
In my opinion, it's got to do with it's a lot to do with where India as a growth country is. If you look currently, even for this year, India is one of the few countries that stands apart in terms of its growth trajectory. And we are seeing that sustaining. As long as that GDP growth, continues at a reasonable pace, we are the oft abused elephant in the room. We kind of walk at our own slow pace, but that slow pace has been good. As long as that pace sustains, this trend will not necessarily change. If that pace for any reason comes under stress, then we may have concerns about it. But I don't see that as a concern. And we as a house don't kind of see ourselves in a situation where we have to second guess on what the growth for India could be.
We really appreciate your time. Thank you for joining us. Well, from what
Thank you very much for having me.
Well, what looked like a very small dot in terms of the luxury spending in India now has really become a mainstay, so much so that Macquarie has also come out with a report where they're talking about luxury cars, luxury shoes, luxury bags, and when it comes to luxury, I'll have to turn to my right hand side to look at the ladies. Let me just see.
Yes, no comments.
No comments.
Pleading the Fifth Amendment. Yeah, taking the fifth.
All right, Hitesh Doshi joins us now, Chairman and Managing Director of Wari Group, and well, we've been engaging with him to understand that how things on the alternate energy or energy transition front have been moving. We've been talking about how energy prices have come down, but today we'll talk about something which directly could be affecting his business. So while energy prices are coming down, the price for solar panel have also collapsed. What does that mean for Wari? What does that mean for solar pricing? And is this largely because of a glut situation which is happening in the world? Hitesh bhai, good morning. Thank you for joining us. Can you simplify for our viewers that why have the solar wafer or panel prices virtually have collapsed?
Thank you. Thanks for inviting me, and good morning to all of you. Solar prices were naturally, they were coming down for last 15 years constantly. But the recent decrease in 4 weeks to 6 weeks at 50%, this is definitely because of the oversupply, probably. And the secondly is the strategy by the few manufacturers of few countries, I will say, to make sure that the production does not happen outside their countries. And there has been a lot of discussion all the time across the globe, how the multiple supply chain can be developed. Almost all the countries are working to start or protect their local manufacturing. And probably to stop it, if you look to the prices, there is no change in terms of the raw material prices or the demand or anything. But then there is always a question why the price has came down if there is no big change in across the value chain. So I think this is more to oversupply and to stop the production outside.
But you are in a competitive market. Now, whatever may be the reason, bottom line here is that prices have come down. And when prices have come down, your buyers, I'm sure they would like to renegotiate. I'm sure your buyers would say that, look, if prices have come down, why should we pay you more? So what happens to your business?
Of course, this industry is known for the renegotiating the contract, and we are the part of it. Fortunately, majority of our customers, with them we have the flexible pricing module, where the raw material prices are linked to their finished product. So in that case, we are not affected that much. But overall, I agree with you, this industry is in that line.
If I look at a very basic business matrix, profit is a function of top line and margins. Because prices are down, your turnover will come down or your volume will come down. Even if you're able to maintain margins, your profitability will get affected. Is that true, that it could be a decline in your profits, or you will be able to sustain it?
I think we are on the track, and we will be able to sustain our margins because the customer has agreed to give our margins, but to change the prices according to the market. So that the benefit Wari have.
A simple follow-up question, which is that, do you think in 6 months from now the prices could boomerang up? Do you think there is a possibility of that what we are going through in terms of a drop, it is just transitory?
Yeah, this is, if you look to the most of the research houses and the media reports, particularly in the Western world, and also when we speak to our counterparts, the issue is the price today is not the price of the raw material. It is a far below. I can give that straight number so you'll get some more idea. The prices before few months were 26 cents in China per watt. So 26 cents US dollar has came down today below $12 US cents. So if somebody does the simple maths of the raw material cost, and these are the commodities like aluminum, glass, and plastics and other things, it's not covering the raw material. So what will happen? A lot of companies who are dumping the material at this price, either they will go out of the business or they will reduce their production, or maybe some of them will stop the production. So there are the expectations, few companies may go out of the business, and then the inventories which are piled up today, and this is one of the reasons why the prices are also coming down. These inventories will also come down and the prices will start going up where some sustainable margins will be made in.
But what you are telling us and what you're sharing with us is that even though the panel prices have come down, energy prices have come down, it is not affecting your business. There are no order cancellations. There is nothing which in a sense will have an impact on your business. So can I assume that now prices have come down, affordability will increase because ultimately power production is a function of the equipment, the price of the equipment and the underlying financing cost. So can I say that this is actually a blessing in disguise as demand will go up?
Yeah, I think this is the best opportunity when you are getting the solar panels at half of the price and across the country, energy prices are going up. It may be small or big, but the large consumers are paying the higher bills today. So this is a very good opportunity for everyone to go for a solar and get this benefits and the opportunity what is available of the prices today.
The other thing to watch out for is when you look at the domestic market in India, everybody from an Adani to an Ambani to a Tata Group, everybody is investing a lot in getting these solar PV manufacturing capacities, which will quickly come on board over the next 12 to 18 months. Do you see this as a sustainable trend in the sense that next 5 to 10 years there will be enough demand, or there will be a sudden situation of a sugar high and then a crash?
If we look to the demand, we have just scratched the surface. For example, today in India at 70 gigawatt capacity of solar, even if we take 20% PLF, we are manufacturing generating the electricity of 14 gigawatt. And we know that what's the demand against this percentage here. So we are not even at 2-3% today. And solar is not going to be used only for the electricity. It will be used to replace the fuels in our cars or in our factories. So even if we have to go to the net zero 2070, the capacities which are coming up in India and expected to come, I think they are not enough. And this demand will continue to grow. And this is what we are seeing in the past.
What about your outlook in terms of green hydrogen? Can you walk us through what the plan is?
The company has a plan to start the electrolyzer manufacturing in India. And we are working in that direction. So this is the first step we want to take on a green hydrogen side.
On course, Hitesh Bhai, the financial closure, filing for DRHP and then going public 3 months from now?
We are working on the DRHP. So I think once we file it, probably we'll be able to give some estimates. Maybe in the next 1.5 months, we should be ready to file the DRHP.
And what about the financial closure? I mean, you've been expanding in Orissa. Have you got the financial closure? Because first financial closure and then DRHP. That is how the process moves, right?
Right. It is almost done. Probably it should be finally concluded in the next week.
Conclude today's interaction, Hitesh Bhai. You are of the view that yes, prices have come down, but this is something which is temporary. And this is not something which will structurally change the industry, because that's what, sometimes investors and markets get worried about, that when prices, they collapse like this, is it end of the road of at least this transition or this entire sector per se?
No, actually, this is a very regular phenomena. Like when we started the solar, we started with 400 rupees a watt. And today we are talking about less than 15 rupees or 16 rupees a watt. So there has been always, it was coming like this. Some jerk, maybe 2-3 months issue, 6 months issue. Again, it will start stabilizing and going up. And in the long term, the technologies are getting developed and all the technologies are working towards the two things. One is how the LCOE comes down and how the solar can give the 24/7 power. So this will continue. But as long as demand is concerned, like you ask about the consumers, we look to the roofs today from our window. In Mumbai, we don't see even 2% roofs are covered. So 98% market in Mumbai alone, we don't go to the tier 2, tier 3 cities or villages. But the developed cities like Mumbai also, we don't have still 98% roof covered with the solar. So demand will continue. The prices, this is a part of the industry, cyclic issues I call them, and they have been in my 15 years of solar at least 5 times, and this will continue. I don't think that this will impact anything on the demand side or the profitability side.
Good to have you on board. Thank you so much for taking time out, Mr. Doshi, and giving us more insight into your IPO plans, the solar module prices falling, as well as what the outlook is when it comes to green hydrogen. Tell you what, let's move right on, focus in on the markets, find out the chartbuster ideas. Naresh Mirani, Kunal Bothra joining right back in. And Naresh, let's start off with your chartbuster idea from the infra space.
So the whole infra space has been buzzing for quite some time, and one of the oldest names in this sector, which used to do well really in the previous cycles, was IRB Infra. Now, the stock has gone sideways for the last almost 10-12 years. The stock used to be 31 back in 2010. It topped out around 28 in 2015 to 2018. And then for 2021 to 23, that base was around 34, 35. So it's been a 12-year period of sideways consolidation. Multiple times it has gone back to 7, 8 levels. And now finally it has broken out above the 34, 35 mark. So a breakout has done good volumes in the last 2 weeks. Expecting this to go towards 45 to 55 in the short to medium term. Stop loss to be kept at 35.
All right, let's move right on. And Kunal, find out your top chartbuster call.
Well, it's on a mid-cap name, Pennar Industries. The stock is heading towards a combination of a triangle as well as a diamond pattern breakout on the daily charts. As you can see, the previous time when the stock had given such a kind of a similar breakout was when the stock made a new high, a swing low for itself over the span of the 3 to 4 months of consolidation. But then when the breakout was confirmed, it led into a very strong rally for the stock price. We're seeing a very similar kind of a diamond pattern for the stock, where it made a high 115, then a new swing high of 120 approximately, fresh swing low for the stock on a relative basis, and now the stock is on the verge of a breakout. So this 120 odd mark could be considered as a strong breakout point for the stock, expecting the stock to move up to levels of at least 140 to 150 over the medium term.
Okay, so those are the chartbuster ideas, but let's also get some mid-cap cracker ideas from our chartists. Naresh, you go first.
So first is the Bayan Container Corporation, the only PSC left to outperform, has given a short-term breakout. Stop loss at 745, target price of 800. Second is a Bayan NCC, a fresh breakout here as well. Stop loss at 164, target price of 190.
What about you, Kunal? What is the stock that you are recommending today?
So BF Utility is the first stock which I would suggest to buy. A Bollinger Band breakout for the stock after a period of major consolidation. Targets of 740, stop loss at 648. And second would be a Bayan Sale, expecting many of the metal stocks to make a strong comeback. Targets of 98 for Sale and stop loss at 88.
All right, we'll take a very short break right here on the show. Be right back with lots more market talk and corporate guests.